It's a bear. Good morning. Hey, what's up? This is Brian Kuzmar with Commercial Rare Coins and Precious Metals in beautiful Lauderdale by the Sea. I know I always say that, but it is a beautiful little city. I've got the live Deerfield beach cam up right now. Look at the water clarity, and beautiful. It's like mid-70s out there. Water temperature is probably even warmer than the air temperature today. Lots of look downs, and actually there are some mangrove snappers. I believe those are mangrove snappers or lane snappers or something. Lots of look downs, and I saw a few kudas out there. Kudas, and some sergeant majors, a bunch of different things. Well, anyways, cool cam. It's the live Deerfield beach cam. If you're interested and you like to relax with the coffee and look at the fishes, especially nice if you don't have a fish tank. Well, let's take a look at spot prices today. I'm going to talk about a couple things here. I'll discuss the fund show, kind of what I saw there. Not a lot to talk about as far as the fund show. It's mostly rare coins and stuff. And also discuss the real rates versus gold prices, what the taper might mean for gold and silver buyers, and what raising interest rates may mean for gold and silver buyers. It's not what most people think. Well, oh man, look at that. There's a filefish back there. See him right there? Pretty cool day out there. Well, let's take a look at prices. I'm going to do a quick update, and let's see where we're at right now. Kind of sideways. For all intents and purposes, we're near that $1,800 mark. Let's see what the low was, $1,791 and $1,802. So we're kind of range bound with gold, it looks like. And silver, similar thing. 22.22 is the low, 22.51 is the high. We're currently sitting at 22.42, and platinum at 932.76. Boy, platinum took quite a whack there. Low at 927 and a high at 966. And palladium, who cares, because hardly anybody buys it. Let's take a look at the 24-hour charts. By the way, I think platinum is definitely a good buy at that. Let's see if it drops even lower than that. I kind of doubt it, but again, tough to say right now. I think anything below $1,000 on platinum is cheap, though. That's just my opinion. And I believe the same thing with gold and silver. Anything sub $2,000 is cheap in gold. Anything sub $30 in silver, in my opinion, is super cheap. And I think we're going well beyond these levels at some point. And but you know my opinion on that. Let's take a look at the 24-hour charts here real quick and see what we got going on. And let's see where the action might be. Of course, this was last night's market. So when last night's markets opened, Sunday night markets, looks kind of sideways and then kind of drifted down a little bit in the probably, and I'm not sure which market it might have drifted down in. Hard to tell here. Hong Kong, Sydney, and the Globex markets are open 24 hours a day. And you know me, I'm always suspicious of any down markets that are happening in the evening. I'm suspicious of the Globex markets because owned by comics, and that's where most of the monkey hammering occurs, again, in my opinion. Let's take a look at silver and see what the overnight charts are doing here. Yeah, silver the same way last night, kind of drifted sideways in that 22, 20, 30 area. And again, this morning we open up, and what do we got going on? Take a look at this. Where does that precipitous drop occur? Occurs in the crooked New York comics markets, of course. But I've kind of noticed this pattern as well. For a while, you know, as I've said in the past, you know, I've been doing this since 1977, and started working for my father, and I've been following these markets daily for years and years, and you start to see patterns. The pattern that was typical in the monkey hammering markets were Sunday nights, thinly traded holiday, or thinly traded markets during holidays, thinly traded markets in Globex in the evening. That's when they were typically monkey hammering the price of gold and silver. The COMEX big players out there, whomever they were, some have been caught and fined for this as well, so we know what's happened. It's no longer in the realms of conspiracy, it's in the realms of fact. But of recent, the last 2, 3 months, 4 months, gosh, time goes by for me. It's hard for me. I can spot these patterns, but again, I can't tell you exactly when they occurred this month or last month. But again, the pattern has been getting monkey hammered primarily in the New York markets at the opening, sometime between 8:20 in the morning, I believe, when the New York Crimex opens, and around noontime is when it kind of would taper off. And we've seen that happen for a little while, driving the price of silver down substantially, down to that $21 mark. Now, all of a sudden, it seems to be happening. I mean, take a look at that. COMEX markets probably, I'm not sure what time that would have been, probably 9 o'clock or something like that, whenever. But take a look at that little drop right there. And then all of a sudden, rubber bands back up. Well, I suspect that the people that are shorting silver, the big commercial banks that are shorting silver and gold, and all their little tricks they use to drop the price down to buy back those short positions is starting to fail them. I mean, look at that. I mean, that's just temporary. And we've been seeing a lot of this the last couple of weeks, actually. These big drops, and then all of a sudden it equally bounces back to where it was or even higher. Again, you kind of see the market is kind of doing well here. Well, that was on Friday and the opening. And let's take a look at today. Again, the same thing. Look at New York NYMEX New York Crimex markets. But it looks like the drop kind of again started maybe in London. I'm not quite sure. That market would have been open right here where I'm circling. Also, again, the New York Crimex, Globex, Comex markets are open about that time too. So maybe this drop occurred before New York even opened. Tough to say. They are really trying to hammer that price of silver down. Too much money to be lost. Again, if what we're hearing is true, the big four commercial entities in Comex that hold these huge short positions. As of yesterday, I think, or this weekend, Mr. Butler said their total losses, if they were cashed out right now, would equal $8.5 billion. So they need to kind of buy back those short positions and drive this price down. Maybe that's what you're just seeing, but not staying there for long. I think they're going to get hurt on this one possibly. That's if, again, look at too with Bank of America's, the rumor out there, and probably pretty much true rumor, is that Bank of America is sitting on a 800 million ounces short position that they've actually leased, all right, which is even more dangerous. So there's lots of strange stuff going on. And if Bank of America would probably fail if silver prices shot up dramatically, considering that if they do own this 800 million ounce short position that they've actually leased, because they can't resell that lease position. They have to replace that physical. So this could be a very bad situation for Bank of America. I'd be very nervous if I had my money there. Again, if this is all true, that they do have this huge position. And the next question you got to ask yourself is why do they own this huge position? Why did Bank of America get this huge short 800 million ounce position, leased silver that they have to actually replace, that they can't roll over? Why do they have that position? I mean, it sounds either super dangerous to me, or they got some kind of inside information that nobody knows about. And again, I guess you can't discount either of that, could you? Well, let's take a look at the stock market, what's happening out there. It's been kind of sideways. I'm going to do a quick refresh here, but not now. Monday morning looks a little trashy here. Dow Jones is down about 400 plus points. S&P is down 72. Wow, maybe this is the beginning of the end of this long-term bull market we've had in equities. I don't know. Let's see. It never ceases to amaze me what free, cheap money does out there. And speaking of free, cheap money, we're going to talk about interest rates here, and the Fed talking about raising interest rates and tapering, laying off the assets that they're buying. What effect will this have on the price of gold and silver? There's a lot of talking heads out there that are clueless that'll tell you that, oh man, higher rates mean that gold and silver prices are going to get killed. No, it does not, folks. Bunch of bullshit, mostly. I mean, if they were indeed true higher real rates, perhaps, but no, not really. Especially in these times. Let's take a look at crypto markets as well, obviously, because it is a big marketplace out there, and see what they're doing. They're hemorrhaging all month. Most of this market is right here, and let's see what let's look at just the 1 month chart there. Overall, it doesn't look too good. The 1 year, but if you look at the 1 year, boy, well, I guess you'd still be happy to own Bitcoin if you didn't buy it on these peaks right here. If you bought Bitcoin at these levels, you're probably happy. But again, look at this. Look at the range of this. This is not a. This is highly speculative, crazy shit right here. Take a look at that. 60. We're down to 40 already, and I think Ethereum even got hit worse. But I'm not a crypto play, so I'm not going to even talk about that too much. Hey, let's get into what the real article is today, which is, will the Fed walk the talk, or will the Fed walk the hawkish talk? We've been talking about this quite some time, and I've been telling you that the Fed is simply just jawboning, because that's all they can do. That's all they've done since 1913 is jawbone these markets. Excuse me one second, a quick sip of coffee here. Or 2 sips. Well, and I've equated the Fed to being like the captain of, I'm not going to say that, let's say the Titanic, all right? But the Fed is the captain of a huge ship that is sinking. The huge ship would be called, the economy. You can say a domestic economy here in the U.S., but really the world economy, the global economy, because everything relies on the U.S. dollar so far. And so the Fed is the captain of this large economy, this large ship. And this ship has been sinking since 1913. It really has. And it's gone downhill. We could take a look at the charts. I can show you the charts. It's pretty simple to see. But the buying power of the U.S. dollar since 1913 has fallen. It's worth pennies of what it once was. And more so since Nixon took us off the gold standard. Again, all you got to do is look at the charts and look at, here, take a look here real quick. Since I'm saying take a look at the charts, let's take a look at the charts here. I think this is the one that I'm going to look for, is the CPI graph. And let's see, we're going back to 1913. Consumer price index for all urban consumers, purchasing power for the consumer dollar in the U.S. average city. So this is what your dollar would buy. A lot of stuff back at that time before we handed the reins over to the Federal Reserve or central bankers. So the dollar bought quite a bit, and look where we are today. The dollar buys less and less, and it's declined ever more so from this point on right here when Nixon took us off the gold standard entirely. You can see the drop just even gets worse from there. So here we are, folks. And as I said, what is the Fed's job? The Fed chairman's job is he's the captain of this sinking ship. A good captain is not going to be at the helm of a sinking ship and be on the PA system telling all the passengers, we're going down, we're all going to die. Even if he knows it, he's not going to do that. A good captain is going to keep everyone on the ship calm until they go down. But really, a good captain is going to try to get everybody off the ship safely. But my analogy is that's kind of what the Fed has been, Fed spokesman, Bernanke to Powell now, Yellen, all they have been as captains of this sinking ship. And their job simply is not, they know there's no rescue. They know that this line, you see this line right here, this line is never going back to this, ever, ever, ever. The U.S. dollar will never go back to the buying power it originally started out with. So it's a sinking ship. And they know this. They know the ship is sinking. They also know that no fiat currency has ever survived as long as the U.S. dollar. So they're in experimental territory right now. And we are the experiment. The dollar is the experiment. And the job of the Fed is just simply to keep these passengers calm right until the ship goes down. So, and that's what they've been doing. They jawbone you. And that's what these rate hikes really are about. They're jawboning these rate hikes. How long have they been talking about rate hikes? Since 2016, they've been talking about reducing the asset buying that they've been doing and raising interest rates since 2016. And then they do it like 25 points or whatever it is. Minor, insignificant, and certainly not enough to catch up with inflation, that's for sure. Couple of things I want to take a look at first, and here we go. Since I'm talking about interest rates, oh gosh, I was going to talk about this article. On Tuesday last week, and this is by a Craner, I'm not quite sure who that is, but interesting article. I'm not going to read the whole thing, just some key points here. The market got spooked by the release minutes of the Federal Reserve Open Market Committees held 3 weeks prior. Now again, this was a couple weeks ago, January 4th. What was the fuss about? Well, the minutes indicated that the Fed seemed to be inclined to envision starting to prepare to begin planning to initiate raising, boy, that's a lot of words there to describe one thing, raising rates, sooner and more aggressively than previously thought, and to normalize their balance sheet beginning already towards the end of this year. Participants generally noted that the individual outlooks for the economy, the labor market, and inflation may become warranted to increase the federal fund rate sooner or at a faster pace than participants had originally anticipated. And this is obviously spooking the equities markets out there, because The equity markets really are all about being able to borrow cheap money to buy back your stocks. You know, for corporations, they can borrow money really cheap and buy back stocks, which causes their stocks to go up in value as well. It also allows people that can get this money at low interest rates to buy stocks and buy into that market and do well with it. The rest of us will pay much higher rates for sure, and that's what people are freaking out about, is them possibly raising rates. Now, will they raise rates? More than likely they will, but again, will it be meaningful? I don't think so. A couple things I want to do first before I go there for some of you. I think this is important. Real rates versus nominal interest rates. What's the difference? Because you hear the term real rates versus nominal rates. And just a quick explanation here. And again, if you don't understand words when you're reading, and there's a lot of financial economic terms that kind of go over my head a little bit that I have to read. So don't ever be afraid to do that, because it's really important you understand what the authors of a lot of these articles are talking about, or what real rates versus nominal interest rates really are when you hear these talking heads on TV talking about it, or you hear people like myself talking about it. So Investopedia is one of the best websites for that, I believe, as far as learning new words and, well, anyway, definitions and such. Let's read what real versus nominal interest rates are, and I know a lot of you know this already. A real interest rate is an interest rate that has been adjusted to remove all the effects of inflation to reflect the real cost of funds to the borrower and the real yield to the lender or to an investor. A nominal interest rate refers to the interest rate before taking inflation into account. Nominal can also refer to the advertised or stated interest rate on a loan without taking into account any fees or compounding interest. So why is this important? Well, there's a theme out there with talking heads at your big corporate financial media like Wall Street Journal, MSNBC, CNBC, and a lot of people that kind of just parrot what they say, that have said over and over that, well, when treasuries and bonds and stuff can pay a higher, or not bonds, because bonds were paying higher rates but very much riskier, but when treasuries and stuff are paying a rate above and beyond what inflation, and that would, I'm sorry, let me back up a little bit. What we've got going on here right now is that real rates are far worse or less. Hold on a second. Oh my God, here. Let me have another sip of coffee here. I confused myself, and yeah, I'm not perfect. I'm sorry. Had to figure out where I was going with this. All right, real versus nominal. So there's this belief out there that when treasuries start paying more than what the inflation rate is, say for example the rate of inflation is like 3% when you figure in the cost of living, the rate of inflation and everything else, and if the treasuries are paying 4%, at the end of the year you're making really 1%. I mean, even if treasuries are paying 4%, if the cost of living and the cost of inflation and the value of dollar keeps dropping, and that equates to 3% per year, and indeed you're only making 1%. But the problem with this is that real rates versus nominal rates, as far as this goes, is a totally different thing. The cost of living is far higher than what the actual interest rates. For example, like, let's take a look at interest rates right now. Gold versus Treasury, which do you believe? Let's take a look at interest rates right now. 30-year, for example, Treasuries at 2.11%. That was on 1/7. That's what they're paying. What is the actual inflation rate that we're in right now? I think the official inflation rate, and let me take a look over here. We'll take a look at that next. Where is the official inflation rate? I don't have it up here, unfortunately. But the official inflation rate is much higher than the 2.11% you're going to get on a 30-year fix. And of course, the smaller, or the ones that are dated for less years, you're going to make less money on. But using a 30-year 2.11, that really pays nothing if you really think about it, compared to what the cost of living is, which might be at 4 and 5% according to the CPI. So that's the difference between real rates and nominal rates. So Gold versus Treasuries. This is kind of an interesting article that I found that got me thinking about this. This was done in October 13, 2010, and I'm going to read this real quick. Any psychoanalyst looking at the behavior of investors today would see clear strains of schizophrenia, and remember, this is 2010, in a comparison between the markets for gold and U.S. Treasuries. Currently, the 10-year Treasury is setting new lows on a daily basis in the financial models that all economists were taught at schools. This would be an indication of an economy with a low inflation expectations and a strong currency. But the dollar has fallen 12% since June, and the price of gold continues to hit an all-time high. These results are completely antithetical. Bonds are flashing a warning sign of deflation, which gold and dollar presage hyperinflation. During the last period in which the U.S. experienced significant economic stress, the late 70s and the early 80s, the markets in gold and treasury showed a much higher degree of harmony. At that time, the Fed's extreme depression of interest rates led to rapidly rising inflation, a weakening dollar, and a massive spike in the price of gold. More significantly, the yields in treasuries soared as investors demanded higher rates as compensation for the added inflation risk. In other words, everything made sense. Beginning in January, now this is interesting again, like I said, this article was written in 2010, but he points out, beginning in January 1977, gold began an epic bull market which ended just prior to February of 1980. In that time, the metal soared from $135 per ounce to just under $860 per ounce, and the dollar index lost about 20% of its value. Yields on the 10-year Treasury soared to 7.2% in January of 1977 to 12.4% in February 1980. This occurred in an environment where the Federal Reserve under Arthur Burns pursued an inflationary monetary policy. He increased the monetary base from $62 billion to $114 billion in just 8 years. And hence, again, gold prices went from $135 to $860. Today, and remember this article was done in 2010, the environment is similar to what the country confronted 30 years ago. Like then, our monetary base has surged, but this time even faster. Instead of merely doubling in 8 years as it did under the Burns watch, Alan Greenspan and Ben Bernanke have tripled the base in 12 years, from $621 billion to over $2 trillion today. Again, 2010, folks. Accordingly, the dollar price of gold has more than quadrupled from $280 to $2,000 to over $1,300 today. In 2000 to over $1,300 today. Over that time, the dollar has registered a 35% drop in value. However, in stark contrast to 1980, the yield on the 10-year Treasury note has collapsed to 6.6% in 2000 to less than 2.4% today. So think about this. Gold was going up in value even when rates were at 6%, and even as high as, look, as he mentioned, Treasury soared from 7.2% to 12.4% in 1980. So, you know, the Treasuries were paying, and what would you call that? You would call that nominal rates were 7.2 to 12.4%. What inflation was at the time was probably even much higher if you take a look at it. And did the price of gold go down? No, the price of gold went up, even with the higher nominal rates. So the idea that people today are talking that, you know, as soon as rates are increased as far as interest rates, and again, it's going to be minor, folks. They can't do it too much, otherwise they'll break the country. Is going to be the theme out there that's why gold and silver prices are, amongst the stupid people out there and the talking heads and the people that don't understand gold and haven't followed the market at all and don't understand the history of the gold market. They're going to say, well, raising rates is going to hurt the price of gold and silver. Folks, unless they can raise rates to 12% again, I don't think it's going to hurt the price of gold and silver at all, especially at the meaningless 25 basis points or whatever, even 50 basis points that they're talking about raising it even a couple times a year. Again, what is the current, let's take a look at what Treasuries are paying currently. And where is that? Right here, 10-year Treasuries and 10-year break-even inflation rate. There you go. It's currently sitting at what, 2.46% according to the government. I think that's nonsense. And what else are we going to look at here? Sorry about that. Easy to get lost in all these graphs. Let's take a look at gold versus real yields. Now, real yields is what we're talking about, the yields that you're going to get if you invest in treasuries or something like that, above and beyond what the inflation rate and what the loss of the dollar buying power is, will give you, real yields. And let's take a look at the price of gold versus real yields. And there's a real yield, Treasury yield right there, 0.97%. You can see the price of gold right there at $2,000. So I don't know how much raising rates is going to have an impact on the price of gold, because if you just look at these charts, it doesn't have a significant impact to gold. Look where they've raised rates here. I mean, it's insignificant, really, if you ask me. Well, I can look at these charts till the cows come home. There's lots of stuff to look at. And I kind of want to say that this is really good suggested reading for you folks. First, go and take a look at the U.S. Department of Treasury Resource Centers. They give the current yields right now. And look at the 10-year break-even inflation rate. There's a lot of cool charts on here, too, that you can look at as well. There you go. Also, this is an interesting chart right here. It's called Long-Term Trends, Gold versus Real Yields. And where else are we? Macro trends, of course, is one of my favorite charts as well. The whole point of this conversation, folks, is that you're going to be hearing a lot about taper in this next year. And you're going to be hearing a lot about raising interest rates. And there's going to be a lot of talking heads and clueless idiots that are going to tell you that raising interest rates at meaningless levels is going to have an impact on gold and silver. It won't in reality. The only way it will is maybe the perception of the dumbasses out there that believe that nonsense. But no less, they would have to raise rates to 10%, 12% in order to keep the prices of gold down and make it worthwhile to go into treasuries instead of gold. And the other problem too is gold, it's never going to go bankrupt. It's never going to go away. Is it possible that treasuries could kind of default in our future? I don't think it's impossible. Maybe 10 years, if you asked me that, I might have said, no, that's impossible. But now, I don't think it's impossible that treasuries could default. I really don't, based on how our governments run and how they run the country now and how they run the economics. I believe it's completely possible. But that's never happened with gold, and it never will happen to gold. And let's see how well the Fed can keep jawboning all this. Well, let's move into, oh gosh, I'm going to thank everybody for watching last week's video, and all the people that commented. I'd like to thank you as well. I was at a coin show, so didn't really get a chance to talk about too much. And let me see if there's any questions I have here. Not too much in the way of questions. Again, I'd like to thank all you for watching, and I'll keep this video a little bit shorter today. Get back to answering some questions this week. Well, that's it. This is Brian Kuzmar with Commercial Rare Coins and Precious Metals in beautiful Lauderdale by the Sea. Call me anytime at 954-493-8811 between the hours of 10 and 4, Mondays through Fridays. Happy to help you out with the best deals are, and again, your questions as well. If you don't live in my area, I recommend that you find a good local dealer. I advertise to beat APMEX, SD Bullion, and JM Bullion, their prices, and your local dealer should be able to do that as well. Plus, you get good face-to-face advice. Again, if you live in South Florida, feel free to come by anytime or call and ask questions. If you don't live in my area, please find a local dealer. And if you got any questions, feel free to put them in the comment section. I'll be happy to try to answer them. Hey, thanks for watching. Have yourself a great day, and I'll talk to you tomorrow. Bye now.